China is paying way more for silver than the West right now. In some places, the gap is $10, $20, even more per ounce. And it's happening as China's SHFE silver vault stocks just hit 349.9 tons, a record low. If this is real, it's not a China story. It's a global silver story. And it could be the kind that breaks paper prices and forces the world to pay up for real metal. Subscribe to the Bullion ledger, because the next move in silver might surprise everyone. This story sounds crazy at first, but the numbers are real enough to track. And once you understand what's happening, you'll see why traders are getting nervous. Here's the simple problem. Silver is a global metal, so prices should not split like this for long. When prices split, it usually means one market is short on real supply. China's market is showing stress. The West's market is still acting like it's business as usual. And that gap is the warning light on the dashboard. Let's talk about the number that started the panic. On February 6, 2026, SHFE silver vaults hit 349.9 tons. That is a record low, and it matters because vault stocks are the ready silver for that exchange. Even more shocking, the drop was fast. The data says the vaults fell by 62.6 tons in just one day. When you see a move like that, it screams, someone needed metal now. Think of vault stocks like water in a tank. Price charts show what people say they want. Vault stocks show what people actually take. If the tank keeps draining, the exchange has a problem. It can still trade paper contracts, but delivery gets tighter. And when delivery gets tighter, physical premiums rise. That is how you get a split price. The paper price can fall while the physical price stays high. And that split is exactly what people say is happening between China and the West. This is not proof of a total shortage, but it is proof of stress in one of the world's biggest silver hubs. And stress is how squeezes begin. Now, here is the part that confuses most people. Silver prices crashed hard, and you would think demand would slow down. But instead, vault silver vanished even faster. Why would that happen? Because a crash can break weak hands, and it can trigger rule changes. And rule changes can force people to act right now. In the data discussed, a big crash happened and then restrictions showed up. When exchanges feel risk, they raise margins and tighten trading rules. That can push traders to close positions fast or switch to physical. Also, a crash can create a fear of paper promises. If you think the system is shaky, you don't want a contract. You want a bar you can hold. So the crash does not always kill demand. Sometimes it changes the type of demand. It turns paper buyers into physical grabbers. And when that happens in a small market like silver, things can get wild. Silver is not as deep as gold, so big flows can move it harder and faster. To understand this story, you need one key idea. China's silver market leans more toward physical trading. The West leans more toward paper products like futures and ETFs. Paper silver is easy to trade. You click a button, you buy exposure, and you can sell fast. But most of the time, nobody asks for delivery. Physical silver is different. It has to be refined, shipped, stored, and insured. And when people demand physical, supply can run tight quickly. So when China pulls metal out of vaults, it hits the real-world system. That can push premiums higher inside China, even if the global spot price dips. That is one way you can get a $10 to $20 gap. This is also why people argue about true price. One side says the futures price is the real price because it is global and liquid. The other side says the physical price is the real price because it is what you must pay for metal today. In reality, both prices matter. Paper sets the headline price that most people see. Physical shows the hidden pressure underneath. And when physical pressure grows, paper prices often catch up later. Not always, but often. That is the risk traders are staring at right now. When markets get too wild, exchanges step in. They do not like chaos because chaos can cause defaults. So they raise margins, widen limits, and slow trading down. A margin hike is simple. It means you must put up more money to hold the same position. That squeezes speculators first because they use the most leverage. This matters because silver is already jumpy. It is smaller than gold, so it can spike or crash fast. And when it moves fast, weak players get wiped out. The video also points to multiple exchanges reacting. SHFE, Shanghai Gold Exchange, LBMA, and CME have all been mentioned as tightening controls. When you see that, it signals the system is trying to reduce risk. But here's the twist. Sometimes risk controls calm the market. Other times, they create new pressure because traders must cover positions quickly. If a large short is forced to buy back, that can launch prices higher. If a large long is forced to sell, that can smash prices lower. Either way, the swings get bigger. This is why the next few weeks could be dangerous. Not because we know the outcome, but because the setup is unstable. Now let's address the headline that makes everyone's jaw drop. Reports say a billionaire trader built a huge short position in silver. The claim floating around is a naked short of about 450 metric tons. If that is true, it is massive. A A short position means you profit if price falls, but if price rises fast, the short can get trapped and forced to buy back. That forced buying is what people call a squeeze. And in silver, a squeeze can move the price like a rocket, because the market is not huge and real metal is not endless. But we need to be careful with language. Not every big short is illegal, and not every big short is naked. And rumors spread faster than facts when prices go crazy. What matters for you, the viewer, is the risk chain. If one player is too big, the market becomes fragile. If rules tighten, the fragile parts snap first. Also, reports say authorities are investigating. An investigation does not prove guilt. It only tells us the situation is serious enough to look at. So don't trade on drama. Track the numbers, watch the vaults, and watch the premium gap. Those are the signals that don't need a rumor to be real. Here's the big reason the world should care. Silver is global and supply chains are global. If China starts paying much more for physical silver, silver tends to flow toward China. That flow can drain stockpiles elsewhere. It can tighten supply for mints, electronics, and solar makers, and that can raise premiums in other regions too. This is like a magnet effect. The highest bidder pulls supply, and the lower-priced market gets emptier. Meanwhile, Western paper silver can look calm for a while. But if enough physical disappears, paper markets face a test, because paper works best when delivery demand stays low. If delivery demand rises during a supply squeeze, paper markets must respond. They can raise margins, change rules, or settle in cash more often. And each of those moves can shake confidence. This is why the price gap is such a big deal. It is not just a random spread. It is a sign the physical market is not balanced. From here, silver can do a few things. It can go sideways, it can whip around, or it can spike hard. And the path depends on whether physical stress keeps rising. One path is range-bound. An analyst mentioned silver could trade between $65 and $85 for a few weeks. That would mean the market is cooling off, even if the story stays scary. Second path is violent volatility. Prices can swing up and down as margins change and traders get forced out. In that world, both bulls and bears get punished. The third path is the blow-up. If a major short is trapped and forced to cover, price can jump fast. That is where people start talking about $100 silver. But do not treat $100 like a promise. It is a scenario, not a guarantee. Markets can stay irrational longer than most people can stay liquid. The smarter move is to watch the signal list. Vault stocks, delivery stress, and the Shanghai premium are the big ones. If those keep flashing red, the odds of a spike go up. Let's bring it back to simple English. A $10 to $20 price gap is not normal. It usually means physical silver is tight in one place. The SHFE vault number, 349.9 tons, is a stress signal. The fast drain is another stress signal. And tighter exchange rules are what you see when risk is rising. This does not mean the world is out of silver, but it can mean the tradable supply is getting harder to find. And in markets, tradable supply is what sets the next price. If you are a long-term watcher, don't let headlines control your brain. Track the data and stay calm. Big money wins when small money panics. If you are a trader, respect volatility. Silver can humble anyone. Use position sizes that let you survive the swings. And if you're just trying to understand the world, this is the lesson. Paper prices can lie for a while. Physical demand eventually tells the truth. This video is for education only and is not financial advice. Markets are risky and prices can move fast in both directions. Always do your own research and consider your personal situation. If you want clear stories that explain money, metals, and power without the fluff, subscribe to the Bullion Ledger. And if you want to follow up, tell me this in the comments. Show me the next vault update.